I'm going to bring up Mr. Isaac Downing to talk to you guys about cost segregation, so let's give him a round of applause. And then if you have a burning question throughout these two guys' presentations, feel free to ask. If not, try and hold it. We're going to bring everybody back up at the end for like a Q&A panel, okay? All right.
All right, thanks a lot, Rich, and congratulations again on the baby. Oh yeah, recently married, guys. Thanks. All right, let me get that clicker from you, Rich. All right, great. Yeah, Rich touched base a little bit on real estate professional status, and that's definitely something I'll touch base a little bit on before. You know, he talked about the 750 hours. Now, it's really important to qualify for that 750 hours if you're going to go that route in real estate professional. But there's also one that you can use for a short-term rental loophole, which you only have to reach, I believe it's 150 hours. That's pretty easy to do, especially for somebody that has a short-term rental. Maybe they bought a property in Crestline like the gentleman earlier today. You're able to do a cost segregation study on that. Get about 30% of that back. First, you're going to offset the taxable income from the property, and then you're going to be able to go back and get that W-2 back as well, too. So it's an amazing loophole, which I'm going to touch base a little bit on right now. All right, I think I pushed the wrong button here. It's not. All right, here we go. Here we go. So just a little bit about us, guys. The United Tax Advisors, that is our firm that I work for. In fact, it is my firm that I developed, and a national tax firm based here in Orange County. This young gentleman right here is myself, recently married self, so that's a great thing on there too. My contact information, I'll have my card up here earlier, right here on this desk. Come back and grab one if you have any questions. All right, I'm going to jump a little bit of overview of cost seg. I'm not going to really jump too deep in it. I'm not going to talk about the tax reform in 1986 and bore your guys' ear off, but just know that something around has been around for quite a while. We'll talk about qualifying assets. What makes a good qualifying asset for a cost seg? Bonus depreciation. Now, this is going to be big, guys. Bonus depreciation is what really made cost seg a big thing here with the TCJA, which is an amazing thing as well, too. We'll touch base on a little bit of case studies, show you exactly what potentially you can get back and how you can offset your taxable income on there, and look at some qualifying properties. All right, let's jump right into it, guys. A little quick history like we talked about before. What I want you to get on this is not something new. It's been around for quite a while here. It started off with the ITC. This is back in '86, major tax reform. The TCJA and bonus depreciation. Now that is what's going to be really enticing for you guys here, especially as real estate investors looking to purchase either a short-term rental property or maybe like that rental property in Crestline or anywhere around here. In fact, you'll see when we start looking at some of the case studies that even though a property as low as $100,000 can yield about a 30% taxable offset, which is great. All right, now we touched base, Rich just did. I was going to touch you a little bit about cost segregation, about depreciation in general. Before I start here, how many of you guys are pretty familiar with cost seg? Are you guys somewhat, have you guys dealt with it before? All right, we got a couple people that have touched base on it, so that's good. At least we know something about it, which helps out a lot. The main key here is depreciation, and that's what we're going to be focusing on. Depreciation is what you're going to use to offset your taxable liability. Now, I've asked thousands of clients throughout my career, the past 20 years, you know, who here likes to pay taxes? Not one person. The goal here is to use that taxable liability and offset it by purchasing property. Now, I have thousands of clients that come to me and go, Isaac, I just got hit with, you know, $100,000 IRS bill. What should I do here? Well, the key is, you know, don't write that check to the IRS. Oh, no. We don't want to do that. Instead of writing that check to $100,000 to the IRS, why not put a down payment on an investment property, one or two, do a cost segregation, offset that taxable liability, and now you have two investment properties as well, too. So let's jump right into it. So how does it work? Well, cost segregation is an offset. So you have your commercial real estate property has a 39-year asset life, and you have your residential rental properties that have a 27.5-year life. Now, if you're talking about short-term rentals, that is looked at as a business. It's not looked at as an actual, rental property because it's a 7-day or under. Now, that allows you to take that offset against your W-2, so that is going to be huge. So the IRS allows it to take certain components in a building and utilize a shorter asset life. So whenever we have a building, think about this. If you guys have any children, if you have any flooring, you know darn well that that flooring is not going to last you 39 or even 27 and a half years. They're running in, they're tracking stuff, they're bringing their bikes in. The IRS has recognized that. It says, Isaac, hey, you're going to get 5 years for that flooring. Now, 15 years, that's all your land improvements outside. If you have some houses here in the IE, you understand it gets hot. That outside concrete, that cracks, the blacktop, IRS has recognized that as well too, and put that as a 15-year asset life. So again, it starts off at 39 or 27 and a half, and then it's segregated out into 5, 7, and 15-year assets. So why do we do that? Well, the main key is by segregating those assets, it accelerates the depreciation, thus giving us a tax deferral and increases the cash. Now that's the main goal here, guys. Increase that cash flow to put that money back in your pocket to go out and reinvest in other opportunities. And like Rich was saying earlier, how does Donald Trump do this? How does he get away without paying any taxes? Well, it's through real estate. And all these top clients that I deal with, anywhere from as low as buying properties for $70,000 to up to, $700 million. It doesn't matter. It's all the same when it comes to this doing a cost segregation study. So look at all these properties as a potential opportunity. Now, the reason we want to do this is we don't want to wait 39 years or 27 and a half years to get that benefit. Quite frankly, guys, I don't think I'm going to be alive in 39 years. I'm pretty confident I'm probably passed away. So there's all that money that you're just letting the IRS hold on to, you guys. Just hold on to this. Hold on to my money, IRS. No, the time value of money is what we're really looking after here. Again, I'm going to talk to you about my stepson that I have here. I went to McDonald's, I bought him a burger and a milkshake. It was $18. It's insane, right? That's a crazy amount of money. So what I'm getting at is get that benefit that you have now and put that back in your pocket and reinvest it in other opportunities before that Big Mac meal is going to be $28 soon. So again, utilize that time value of money. I talked a little about bonus depreciation, and that's what really makes this so enticing. We're talking about 30% that you're going to be able to get back on any investment property. Now, I'm just shooting a single-family residential home. I know we're talking about there's going to be an ADU and a mobile home class coming up here in the next couple of weeks. Those get about 80% back. Imagine that you bought a property for $100,000 and you get an $80,000 tax write-off. That's huge. And same thing when it goes to those tiny homes. I know Rich was talking about maybe buying a plot of land and putting in a tiny home. That's about 90% taxable write-off, and I'll show you here a little bit later. All right, so how does it work? Well, we talked about those building elements. Remember I talked about the flooring, remember I talked about that? But there's also things like lighting. Not only the lighting, but how much does it cost to put that lighting in? You gotta remember the conduit, that special plumbing as well. So we're carving out specific assets, and it's got kind of skewed here. So it's 39 and 27 and a half year from real property. That's gonna be your actual building structure. Like when we're here, of course, this structure, that's gonna last 39 years, but there's no way this lighting's gonna last 39 years, and that conduit. Also, how much did it cost to put that lighting in? So it's all get taken apart. So we start off from the 27, and we're just segregating assets out. Small pieces. We're talking about duplexes, lighting, flooring, outside parking lot, paving, all this good stuff. The benefit for cash is going to be your increased cash flow. And that's what we're looking at here. All of you guys, I don't care if you guys sell a property here, do a cost seg, maybe buy another property, offset that taxable liability, because the end goal is to increase your cash flow by not paying the IRS. That's what we're targeting here. It is an IRS defensible strategy. In fact, the IRS likes you to do cost seg because it really details every little component piece in your actual structure and your actual property. All right, now here is a really good slide. This is something that we made years back, and I really like this because it really talks about how you can use it. Well, first of all, you talk about conceptual design. If you guys are building something, you want to make sure that's going to be the most tax efficient thing out there. So if you guys are building a brand new property in Hemet or wherever you guys are thinking of purchasing a property, a brand new property in Needles, a lot of clients have been purchasing a property out there. In fact, one of my clients purchased that pirate bar area, that's recent area. So, those are the type of things when we're talking about building and designing. We want to look, hey, if I put tile in my flooring in my house, that's a 39-year asset life. But if I put Vinyl flooring or VCT, that's a 5-year asset. Now remember, the shorter life, the more benefit you're gonna get. So it starts off from there. And then it goes, new construction or an acquisition. Whenever you buy a property, this is gonna be the best time to do a cost segregation study. But even if you had an older property, if you had a 5-year-old property you've been renting and you're like, whoa, I just found out about this cost segregation study, absolutely take a look at it. You don't have to amend your return, because I know maybe a lot of you guys have done some creative accounting when it comes to your taxes, which is fine. We don't have to open that back up. You simply file a 3115. Improvements or renovations. Now guys, if you guys have a rental property and you've done any type of improvements or renovations, look at that. Look at a potential cost segregation study. If it runs around $50,000, maybe you don't need to. But if you're running to $75,000 and above, we want to target that, because there's a lot of expenses that, again, the creative accountants will start saying, oh, let's expense all of it. But the one thing we don't want is the IRS to say, hey, Isaac, hey, what's going on here? So, we don't want to raise any red flags. So that's where it's important to be fully detailed here with the cost ed. All right, one of the things I was asking, well, how much am I going to get back from my property? What percentage can I get? Now, guys, these are just some of the properties here. Cost segregation can be done on any type of property. I can tell you exactly right now this week what I have on my plate. I have a tree house in PA. Yes, it's a tree house. It's really cool. You got to see this. It's like these rental Airbnb properties they have, and they're awesome. A client bought it for about $250,000. It's really cool. Auto dealerships, as well as anything, any Airbnb residential properties, mobile home parks. Again, mobile home parks are one of those secrets that really get a huge amount of benefit. I'm talking about 70 to 90% of a tax write-off. Now imagine if you bought it for $1 million, you get a $900,000 tax write-off. What are you gonna do? Well, you're gonna offset your W-2, and you're gonna be on a paper loss. That's the goal here, guys. We wanna be in a paper loss so deep that whenever you sell a property, hey, you got this big fence wall here called a paper loss you're gonna be able to get. Tenant improvements, self-storage is really big. In fact, I was just talking to Brett about a self-storage property. I saw it here. If it has removable walls, it's even better. Again, so all these type of properties, but just know, some of the clients will be like, Isaac, well, what's the deal here? I got an apartment complex. Why is there such a big variance from 5 to 35%? Well, let's think about it. Remember, we're talking about the fixtures that we're gonna be offsetting. If you bought a property in downtown LA, what do you got outside besides homeless people? Pretty much nothing, right? If you got a property in Oklahoma, you got sprawling walkways, you got jungle gyms, you got swimming pools. I've seen some really cool ones in Oklahoma. So that's what's gonna give you the higher echelon here. You're going more along the lines of maybe 35, even 40% I've seen. So great opportunity here. Really easy, just need your basic address, how much you purchased it, and what it is. Just let us know, we'll run the numbers for you free of charge and let you know, hey, this is a good idea to do a cost seg or not. Again, it starts off by just a simple purchase agreement. Reasons for not doing cost seg. Well, maybe you like paying taxes, I don't know. Or maybe you're just flipping the houses on this as well, and we'll talk about that. Well, one of the things is if you have a lot of investors, if you bought yourself that short-term rental property and you had, say, 20 investors, maybe some of them don't want to do it. Maybe you just don't have any taxes to offset and they want to hold on, or maybe they just want to wait and hold on to their property for, or maybe they're selling the property. The thing is, like Rich talked about, the IRS is there to get their money back. If you did something, let's just say you bought a property for $100,000, you bought a mobile home and you got an $80,000 tax write-off. And you're like, all right, IRS comes and knocking, you're like, whoa, let me see that. You show them your cost segregation report, they back off. The next following year, you sell that property, they're like, wait a minute, you just got an $80,000 tax write-off. We want some of that money back. IRS is something you don't want to mess with, guys, so that's what I said, But the good news is this is an IRS defensible tool. So we advise you to at least hold on to the property for 3 years before selling it. Or, now if you did have a property and you decided, hey, I got this big benefit, and you receive this, and now you decide to sell it, well, a way you can mitigate that actual depreciation recapture is through a 1031 exchange, which Mr. Brett Bonecutter is going to be talking about here later. All right, so let's look at those examples of qualifying assets.
So real quick, just a quick three-part agenda, just to introduce myself a bit, to look at some opportunities and some options related to 1031 exchange. So by way of introduction, my name is Brett Bonecutter. That is my real name. I didn't make it up. Some of you may have heard it before. I used to advertise on the radio fairly aggressively on K-Wave and KRLA and KKLA. So if you've heard my name before, that is not an accident. I have a bachelor's degree from the Master's College, an MBA from Pepperdine University, and I have a real estate license, mortgage license, and a securities license, okay? So that's a little bit about me, and my companies are the Bonecutter Group on the real estate side. I'm also with EXP. My mortgage brokerage is the Hybrid Agent Group, and I do alternative investments through Emerson Equity. And again, we're going to be touching on that just a little bit, but that's just real quick, a little bit about me. That's strange. What is that? Oh, okay. All right. Okay. All right. So, again, lots of investors in the room. I'm going to be kind of preaching to the choir here, but, owning real estate is great. However, it does come with a lot of challenges. You've got property management headaches. There's questions about liquidity. Can you take cash out? Are you getting the kind of return that you should be getting? When you exit, what do you do about capital gains tax? And if you want to replace the property, what do those options look like? I mean, there's a lot of challenges there. And so one of the questions for property owners that you are faced with is it time to hold them or fold them? And by the way, this presentation has to go through a compliance officer at my broker-dealer, and they didn't want me to use Kenny Rogers' picture because they thought that Kenny Rogers was somehow endorsing this presentation. And I had to point out to them that Kenny Rogers was dead. So, anyway, the question is, when you own real estate, should you hold them or fold them? And, generally speaking, from a real estate perspective, we tend to think of this three main ways. One is just to think about the macroeconomic environment and trends. Is this a good time to sell? Is it a seller's market, a buyer's market, et cetera? And the time tonight is not to be spent on this, even though it would be fun. However, I think just anecdotally, very quickly, I think we all know it's a great time to own real estate. There is a structural shortage of housing supply in the United States, and it probably will stay that way for as long as the eye can see. And as somebody who's been in mortgage, a lot of people have rates below 3%, and they're gonna hang on to those properties like grim death. So, holding property right now is, probably a pretty good thing to do. The other tool that people use is just to do a comparative property analysis. And, some of you are real estate agents, but it's just to see what are the comparable sales on the kind of property you own. Is this a good time to sell? What we're going to kind of be focusing on a little bit from an investor perspective is a comparative yield analysis. And again, I apologize for the math, but we're going to try to keep this relatively simple. A common investor perspective is to think about yield in terms of the annual net operating income divided by the original price. And so I want you to imagine a scenario, something that I see in Orange County fairly frequently, okay? Somebody bought 123 Sesame Street maybe 10, 15 years ago. And let's say, just in this example, it's maybe a triplex. They bought it for $1.5 million. Their current rents are right around $12,000 a month. They've got expenses of $5,300, so they're netting around $6,600. Their annual net operating income is around $80,000, so that they calculate their yield at 5.3%. And as far as cap rates go, that's probably okay. Now, can anyone spot what might be wrong with this analysis? It's fairly simple, actually. Yeah.
Well, for one thing, you're looking at the whole purchase price, and almost all of us use leverage. So our actual cash-on-cash return is substantially higher. And you're only looking at one of the four income streams from rental property.
Okay. That's probably a more detailed answer than I anticipated, but you get a gold star. But really, good job. I appreciate that. Here's the answer that we're looking for, though. The correct perspective is that you need to look at the current value of the property to really understand the yield. Okay? Because even though they bought it for $1.5 million, and again, in this example, you'll see in a minute, there was leverage. The point is, they're calculating it based on a value that's 10, 12 years old. When you look at what the property is worth now, and let's say theoretically it's worth almost 2.9, their yield is no longer 5.3, it's now 2.8. And in real estate investment, this is what we call cap rate compression. You may have heard that phrase before. And that just means that as the value of your property goes up, your rents generally don't keep pace with the pace of the property appreciation. So it's a great thing that your property is appreciating, but in terms of the actual cash flow yield, that it's forcing your yield lower. And we see, again, I don't want to pick on anybody, but there's a lot of little old ladies in Orange County who bought investment property 15 years ago who think, hey, this thing's cash flowing, I've got, they think in their head, I've got a 5.3% cap rate or whatever. They don't. They've got a cap rate under 3%, and they're underperforming this asset class. Does that make sense? So again, not to overcomplicate matters, the point simply is when you're trying to evaluate should you hold them or fold them, one of the things you want to understand is what are current cap rates, and have you suffered from cap rate compression by virtue of your property appreciating at some of the rates that we have seen. Now, in a case like this, it would be, I think, prudent for this investor to say, no, it's time to roll this asset forward. Okay, to try to capture more yield, to get a cap rate closer to the market cap rate, because to have a cap rate of 2.8 is not good enough. It's a lazy asset at that point. So, what are their options? Well, again, I think most people in this room are somewhat familiar with 1031 exchange. We're not going to take a super deep dive on this, but we do want to scratch at it a little bit. In this case, the owner of 123 Sesame Street would do well to trade up. Okay, and the IRS code makes it possible to trade up by going from property A to property B without having to pay the capital gains. So again, just real quick here, the advantage of a 1031 exchange is that you can retain your equity gains and roll up your real estate investments for an equal or greater value while deferring capital gains tax. It has to be a like-kind exchange, so you've got to do it with real property to real property, okay? Again, from property A to property B. The seller cannot take constructive receipt of funds. The funds have to go to a qualified intermediary. The seller has 45 days to identify a replacement property and 180 days to close escrow. As long as you do that, again, the owner of 123 Sesame Street can sell and roll up to, hopefully, a property that gives her a higher yield. Now, this is the unfortunate math that I talked about, and I'm not going to belabor it, but I think it is kind of somewhat helpful to think through this just a little bit. And I'm sorry to turn my back to you, but I need to be able to see this myself. Right here? The middle of the banner. Okay. No problem. You are welcome. So again, in this case, and we're going to go through this relatively quickly, we're imagining that 123 Sesame Street was bought for $1.5 million with a $1 million mortgage and cash equity of $500,000. That's the initial scenario. Now, when they purchased it, well, the first thing we've got to do is determine their adjusted basis. So we take the purchase price plus the closing costs, plus any capital improvements, minus depreciation, gives us an adjusted tax basis of 1.2475. That's her cost basis in the initial deal on 123 Sesame Street. Okay? Now, though, we need to calculate her realized gain. So in this case, we're saying that she's going to be able to sell it for 2.85. She's going to have closing costs of about $156,000. That gives her net selling price of 2.6, and an adjusted her tax basis was 1.2475. That gives her a realized gain of 1,445,750. Okay. Again, forgive me if this is too technical. You'll kind of see why this becomes important in a moment. So if she sold it for 2.8, And at that time of disposition, she owed $800,000 on the mortgage. She had some closing costs. Her net cash on sale, sorry, I'm not in the middle of the banner. Her net cash on sale is about 1.893, okay? So that's what that looks like in terms of her net cash on sale. But now we've got to calculate her tax liability, and this is where it gets kind of tough, right? She had a net realized gain of almost 1.5. Federal government takes 20% of that. There's also a federal tax on depreciation recapture. So even though depreciation is a very powerful tool, we all celebrate that. I love everything Isaac taught us, and I hope you guys will give him some business to help yourselves there. The government claws back 25% of that. Okay, there's an affordable carriage surtax, and then of course, if it's in California, you're getting the California state tax. So you're almost looking at almost 40% in taxes, which is just hard to believe. So on this deal, without a 1031 exchange, instead of getting 1.893 in cash, she would only be getting 1.351. I mean, it's significant. Now, in a traditional 1031 exchange, she could trade up, but the price of the new property has to be greater than or equal to the sales price, and her debt ratios also have to be greater than or equal to, all right? So again, in a traditional property A to property B scenario, and again, this is all fictional, of course, but she would sell for 2.85, she'd be trading up to a property that's maybe $4.3 million, and she'd be securing a mortgage for roughly $2 million. Again, I know it's a lot of math, I'm sorry, but I think that's pretty much the end of that for the moment. Here's what most people do not know, and that is that you don't have to go from property A to property B, because that's one of the big challenges. As you remember, there's these timelines. In this scenario, she not only has to go find a property that's $4.8 million, she's got to secure a mortgage for $2 million. That's a big pain in the butt. This is one of the reasons why a lot of people don't trade up and don't roll their real estate forward, and they're content with their 2.8% yield, because the whole process kind of sucks. Okay, it's very tricky. This is where my securities license comes in, because there is a vehicle called a Delaware Statutory Trust, where you can roll from property A, instead of going out and trying to find property B for $4.8 million, you can roll into what's called a DST, or Delaware Statutory Trust, which is a trust that holds multi-million-dollar real estate. So let's talk about that just a second. So a DST is a trust that holds institutional-grade real estate. When you invest, you are buying a fractional share in the trust. So you are not necessarily going from 123 Sesame Street to 456 Glendale Avenue. You're going from 123 Sesame Street, and you're rolling your proceeds into a DST or a number of DSTs as a fractional owner. These are professionally managed, so you would not be the property manager. It's purely passive. You can go into different sectors. We're going to talk about this in a second. But there's all kinds of different asset classes of real estate. So you don't have to go from residential to residential. You can go to residential to multifamily. You can go to industrial, retail, etc. And this is a little asterisk here, is this particular strategy for 1031 exchange is mostly suitable for accredited investors. So that means that you have to, as an individual, have made at least $200,000 for the past couple of years, or as a couple have to be at $300,000, or have $1 million net worth excluding your primary residence. Okay, so this is not open to everyone. And the federal government thinks they're doing us all a favor with that, but I won't get into it, but at any rate. So it's not necessarily open to everyone. However, for people who own lots of real estate and are in these situations, they most often are accredited, and this is a good option for them. Now, a lot of people ask me, what's the general hold on a Delaware Statutory Trust? It's usually 3 to 5 years. It is illiquid because you're a fractional owner.